Good afternoon, this is Richard Flax at Moneyfarm. I wanted to welcome you to our asset allocation presentation for 2024, where we'll show you the results of this year's Strategic Asset Allocation. You can find all the details of our latest Strategic Asset Allocation, including estimates and assumptions and further insights, in your copy of this year's document. The Strategic Asset Allocation process is an important part of what we do and aims to answer two main questions. What risks, returns and correlations do we expect from the different asset classes? And given those assumptions, what balance between the asset classes could maximize our risk-reward ratio in varying market conditions? To answer these questions, every year we produce estimates for long-term expected returns and volatility across all the major asset classes over the next 10 years. The process is quite mechanical. The goal is to limit the potential impact of individual bias, even if we won't achieve that completely. Expected returns and risks are also used to identify the composition that will maximize the best outcome for each risk level over the long term. These portfolios form the basis of the strategies we offer to investors. Our strategic portfolios are then transformed into tactical portfolios, where we also consider shorter term variables, such as monetary policy and geopolitics. These are the portfolios we offer to you as Moneyfarm clients. Now let's talk about the expected returns and volatility. Although we believe that these forecasts have value in guiding our choices, they shouldn't be taken as a guarantee of future returns. The chart here represents our expected 10-year annualized returns for each asset class. There are a couple of points to make. First, the return forecasts for equities are generally higher than for sovereign bonds, reflecting a positive outlook for economic growth and corporate earnings over time. Second, the expected returns for sovereign bonds are much higher than they were 2 or 3 years ago, and are now expected to provide a meaningful contribution to portfolio returns. In equities, the expected returns haven't really changed very much from last year. We've seen a slight improvement for emerging markets and a slight deterioration for developed markets. Estimates for dividends, share buybacks and corporate earnings growth contribute to the bulk of the expected returns. That should offset, at least in this scenario, any capital losses resulting from a decrease in valuation towards the long-term historical averages. To put all this into context, let's compare these returns with what we've seen in previous years. The chart here represents the forecasted expected returns from 2014 to 2024 for each asset class. As we can see, although slightly lower than last year, our forecasts for long-term expected returns are on average higher than they have been over the past 10 years. The most significant shift is really on the fixed income side, where the sharp increase in bond yields in 2022 helped pave the way for higher expected returns today. So what do these expected returns tell us about the short term? Not very much. We don't think we should look at these estimates as short-term forecasts. But more importantly, the positive long-term outlook does give us some comfort to continue to follow our low-cost, well-diversified, multi-asset approach to investing. In 2022, the fallout from the COVID pandemic took the global economy into uncharted territory. We saw the impact across all aspects of economic activity, from inflation to government spending and supply chain pressures, to name but three. At the same time, we faced a series of geopolitical challenges, as the boundaries of an increasingly divided world have been redrawn. Over the last 12 to 18 months, we've seen something of a return to normality in terms of slowing inflation, improving supply chains, and the reopening of the global economy. But at the same time, the COVID period has shown us the limits of a globalized world, and that will likely have a lasting impact on the decisions that both companies and governments choose to make. Where do you locate a factory? Is there a trade-off between efficiency and security of supply? What goods and services are truly critical? That will create challenges, but also opportunities. In summary, we believe the long-term expected return outlook is still attractive. That's thanks to higher interest rates and an appealing risk premium for equities. The short-term outlook has its challenges, as always, but the global economy has held up better in the face of higher interest rates than we might have expected a year ago, and that's proven supportive for financial assets. If you have any questions about this year's asset allocation, please reach out to a member of the team. Thank you for watching and for your continued support as a Moneyfarm client. Our aim, as always, is to help build your wealth together.